Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another video. So the title of this video is Shocking. Banks really hate this. So I do a lot of clickbait thumbnails, but I don't think they're working as much as they used to, or something must have changed because I don't get as much watch time or viewers anymore, although I do get about $100 per month. And this is why I'm actually thinking of starting a new YouTube channel because, to be honest, when I first started YouTube, I kind of did it as a way, it was kind of like part joke because I didn't think anybody would ever watch a channel called like Korean Atlanta Mentorship. And then me just like joking around and then just doing clickbait thumbnails, like who's gonna watch this? And then it turns out I do have a very cult following audience, right? But then, at the same time, I'm thinking, I'm kind of over it in the sense that the main reason why I started this channel is so I myself could master velocity banking. So there's a saying that if you want to really learn something, teach it yourself. And so I have all these videos where I taught velocity banking starting from 2023. And I think after, pumping out a gajillion videos, I think I kind of know the subject, right? But I was thinking like maybe I should start a new YouTube channel so that like I could, one that actually gets the numbers with pretty good branding and all that, and then keep this channel just for my own personal purposes. Um, but this channel doesn't do as well as it used to, and I wonder if it's because something changed, maybe like AI impacting the algorithm. I used to get about like 1,000 views at least, and now I'm only getting 458. So, gotta come up with a new YouTube channel, folks. Although I don't know if I'll have the time to do it. But this is why, like, when you're creating something, gotta do it with the team. You don't want to do it all by yourself. Doing anything all by yourself is kind of what I would call, I don't know if death is the right word, but you'll eventually burn out. All right, well, let's go ahead and get started. Velocity banking, what is it? Well, I just kind of do this intro or line opener that you make good money and you have all of this debt. So you have 10 credit cards, an auto loan, and a mortgage, and you only have $1 left over after all expenses are paid. So if you have $1 left over, are you screwed? Do you need to make more money? And that's just how I kind of present it. When I talk about velocity banking, I don't even show this. I just like, velocity banking, what's that? I'm just want to show you something, okay? If you make good money and you have $1 left over because you have all this debt, do you need to make more money to get out of the hole? And pretty much everybody will say yes. So that's what we're trying to do with velocity banking is to show that with the same income, okay, and with the same expenses, right? And we can get out of this hole without making more money. Okay, and so we assume that we do make good money because who do banks lend to? Do they lend money to people who have money or don't have money? Well, they specifically lend money to people who don't need it. Okay, so remember that for now. So what we're going to do with velocity banking, first of all, I didn't even say what velocity banking is. It's a debt payoff strategy where you throw all of your money into debt. So first step to doing velocity banking is creating a budget, and then within your expenses, you gotta have an expense breakdown, list every single debt that you have, right? And then this last line item, I like to kind of put the general expenses that I have, like $3,000. Let's say that's your monthly average, and it depends on where you live and cost of living. So if I lived in New York, it'd probably be higher than, let's say, good old Nebraska, even though everywhere's getting expensive nowadays. Am I right? All right, so with velocity banking, we just kind of do the same thing, except we don't save money, right? So you see this checking and savings right here? We just don't save money. We just don't save it. And what we're going to do is we're going to focus on this thing called cash flow, which looks like our checking and savings when we think about traditional American banking, because our cash flow is kind of considered to be what is left over in our checking and savings, where it's velocity banking. We're not going to save money at all. So if you want to see what this looks like right here, you see money comes in and money goes out. So what's the difference between the current mainstream style of banking versus velocity banking? Well, the mainstream style of banking, so the difference between that and velocity banking is that with the average American banking, your checking account is seen as the final destination of your money, whereas velocity banking, your checking account is like the middleman. Money comes in and you just, send it right out to something called a line of credit. So what's a line of credit? It's basically a financial tool where you could borrow money, pay it back, and then use it over and over again. That's what a line of credit is. And so what we're going to do, okay, with our line of credit is, let me just kind of show you here, is use it as our main operating account. If you don't know what a line of credit is, basically a financial tool where you can borrow money, pay it back, and use it over and over again. See, I repeat myself, I think. I repeat myself a lot. But you see, this is my $373,500 home equity line of credit. So what does this mean? I just go to a bank's website, click a button, and they'll dump up to, whatever the available credit limit is. In this case, it might be 15,000 if that's the credit limit you have, or it could be 373,500. Am I right? Okay. So, yeah. And by the way, if you don't know who I am, okay, I'm going to show you who I am. Basically, I paid off a mortgage in 2 years and 9 months. Yeah, I did. I did. And then another thing too, if you don't know who I am, let me just kind of show you here. I have over $739,000 in credit cards and lines of credit. I know, $739,000. Isn't that crazy? Yeah. So just to kind of get that out of the way, so the reason I talk about that is because a lot of people don't understand the secret to banking. And really the secret to banking is that banks don't lend money to people who need it. Okay, that's like the quote secret of banks, right? They don't lend money to people who need it. And so the way I got all of these lines of credit and credit cards, it's basically I just went to a bank when I didn't need money, right? I went to a bank when I didn't need money. So what we're going to do is assume we have a free and clear line of credit, which is unrealistic because if you have $1 left over, um, you need money. But why do we demonstrate that? Because the most realistic situation that I've seen where you could apply velocity banking, 22 debts and $4 left over is under a paywall, 99 cents. Join the YouTube channel, it's in the live stream. Okay, that's the reason number one. I got to make a little bit of money. I'm sorry, I pretend to be rich on these YouTube videos, but it's all a charade. Wink, wink. Um. Anyways, what am I even talking about? Anyways, we're gonna assume we have a free and clear line of credit because in this instance, a free and clear line of credit, even though you're not making more money, is kind of like getting car insurance after you crashed a car without car insurance, right? Not realistic, but it would be a lifesaver, right? But okay, I want to tell you something. Best time to get car insurance before you start to drive. Best time to get a line of credit, which is kind of like car insurance, is to get the line of credit before you need the money. See, when you go to a bank and you need money, they'll be like, what is this? Like, is this some kind of a joke? Right? But then when you don't need money, they just kind of give it to you like, oh, take, borrow it because you're a safe borrower, right? So a lot of people don't know that. But anyways, let's go ahead and do this cash thing called the cash flow index. Calculate it, really easy to calculate it. Basically, it's the balance of this, the debt divided by the payment, and then what you do is just kind of list them all out, and then you'll get a ranking system. And so basically, the lower the number, that's the one you want to move into the line of credit. And the higher the number, that's the one you don't want to pay off. You want to pay that one off last, right? So basically, what does this high number mean? It means I got to give someone $200,000 in order to get $843 back in my cash flow, right? Whereas I could get, you know, give someone $40,000 to and to get 700, or I just pay these two credit cards and that's more cash flow than the $40,000 loan, right? So basically bang for your buck in terms of cash flow. And then what we're going to do is going to move some of the lines of credit into into or some of these debts into the line of credit. So it's $164,000 of credit card debt. Take these low cash flow index numbers, 164,000, and that's 164,000. And then guess what happens when we move these credit cards into the line of credit? You want to see what happens? You want to see this crazy? Bam, 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 bam. The bank hates you for this. $1 turned into $5,111.83 of cash flow. What? Yeah, I know, it's crazy, right? You see how like uh the the income is the same? We didn't make more money. No, we did not. No, we did not make more money. See, this $1 turned to $5,111.83 of cash flow. And then the final step, okay, is you want to make the money go to the line of credit. So, like I said before, with average American banking, the checking account is seen as the final destination of the money, where the with velocity banking, the line of credit. So you put all of his money into the line of credit as essentially an overpayment. Think about like overpaying a credit card, the same thing, right? And then we just take our expenses out and then rinse and repeat over and over again. And what we're going to do is 5111.83, right? So basically get the next month's balance based on the previous month's balance interest, and then you subtract the cash flow. And of course, every single month when you use the line of credit, you're going to take the average daily balance, multiply by the interest rate, and then you divide by 12. And then we're going to go ahead and do that right here. And all right, so I'm just going to go down here, and then this is going to be month 37, right? 37. And we paid off all the credit cards in month 37. Woohoo! 37 months. And that's going to be 164K, right? 164K. All right, so now what we're going to do, let me go ahead and do this right here, is we have two more loans, the auto loan and the mortgage. Auto loan, 37 months. We have this loan calculator right here where if we put in the current month, right, and just type in 37, and then it'll give you the current balance. Follow the cash flow index right here. We should easily be able to get rid of the auto loan. Whoopsie, my mouse fell down. So I'm going to do this, and then I'm going to just do this, paste values only, plus 1616045.43. Okay, so now that we move that debt into the line of credit, this is going to be 0. And then now we have $5,800 of cash flow. Okay. And then this is going to be 5830.58. Okay, and then bam, bam. So in 39 months, it's all paid off. Okay. So 39 months, and then this is going to be 204K, 4K, and then 39 months. So now the only thing we have left is the mortgage, and then we're going to do something called chunking the mortgage with a 30% credit card. And you might say, why would you do that? It's because if you're, let's say, paying off $10,000 every month on a credit card, they're going to give you a lot more credit, and then you might be able to get $739,000 in lines of credit. My goal is to get like $1 million, although I'm not like too excited about that goal. Maybe I might reach it by next year. By next year I have like $1 million line of credit, and then I'm like, what do I do with this? you know, you ever watch that guy on YouTube where he won like the Powerball lottery or something, and then he was like, what are you going to spend it on? Like drugs and hookers or something like that, or cocaine and hookers. Actually, let me just see. Cocaine and hookers. Powerball? Yeah. Man who said he'd spend Powerball money on hookers and cocaine speaks out. Look how in love she is with him. She's like, my man. Oh man, that's probably what I'm gonna do. I probably don't even need more than like 300,000 in line of credit. If I get to 1 million or 2 million, I don't know. You know what's crazy, and I probably shouldn't talk about this, is that how many times I see like these Asian women getting arrested for like massage parlors. Actually, let me do this. Florida Chinese woman massage parlor arrest. Let me see that. Yeah, you see all this? Asian massage parlors bust. And then this guy like shows the officer dude shows like 21 women who are like hooking up people in Florida. Is that how you say it? It's crazy how there's all this stuff there. Arrest made in ring, and this is 7 years ago. My goodness. Farmington owner wanted for human. Oh no, that's no good. And this one's 4 months ago. Where's Farmington? Where is that? Let me look that up. Farmington, New Mexico. Dang, dang, dang. All right. So, anyways, dang, there's a lot. Eh, Ohio. Man, I thought Ohio was like an innocent place, but I guess it's not. Actually, maybe the kids know something because they always talk about Ohio on social media. Gen Alpha slang. Okay, so let me get rid of this. I don't know why I got distracted about this. But anyways, so even if you use a 30% credit card to quote chunk, and what does chunking mean? It just means you're taking a piece of the loan and moving it to the line of credit, right? So you see right here, this is what we did. This is a 3% mortgage paid off with a 30% credit card, and we paid it off in 2.5 years, right? And then if you move this to 8, you notice how it kind of goes down. But there's a saying that I learned, and I actually learned this from Renatus, believe it or not, is that the best credit decision is not the best financial decision. See, so if you're willing to pay a little bit of interest to the bank in exchange for access to more money, might be worth it. I mean, people do it all the time. I mean, think about a loan origination fee, right? How much is a loan origination fee? It is crazy. And so the reason why I don't think they charge like origination fees for credit cards is because they'll know they'll make it back in the back end with the 30% interest that they charge. Whereas with loans, they have to charge a much lower interest rate. But you see right here, 2.5 years. Let's crank it up to 30%. 2.5 years, right? So anyways, all right. So let's go ahead. 2.5 years. Um, uh, yeah. So I'm gonna do this right here. So 39. 39 divided by 12 plus 2.5. Anyways, 5.75 years, and then we're debt free. Wow, that was really easy. I mean, if you were debt free in 5 years, do you think the bank would hate you? I mean, you have all this cash flow and none of it's sucked by a bank payment. Dave Ramsey was right. Right? Dave Ramsey was right. All right. Anyways, yeah. So if you watched to the end of this video, right? If you watched to the end of this video and you know that you're going to pay off all the debt that you have, type in for me happy ending. Okay? Happy ending. I wonder where I got that phrase from. Anyways, all right. Have a great day, and I'll see you all in the next video.